Hey, what's going on, guys? It's Mike from Better Me. Really good to be back here with you guys, and I wanted to talk to you guys about something really cool. And I wrote 3 things on the board today because these 3 things I believe impact our finances really greatly. Like, these are some of the 3 major things that impact our finances, impact our budget. And so 2 of them are liabilities. So 2 of these things are liabilities. It's our car and our house. And then the last one is food. And when I say food, food is like when you go out to eat for entertainment purposes. Like, you go out to the restaurant, you guys go out with the family, spend a couple $100 on dinner. That's what I mean by food. Not really the food that we go to the grocery store with and we pick out of the grocery store. Although we could definitely work to kind of create a budget to be able to say, okay, like, well, maybe today I'm not going to get the organic brand. Maybe I'll do conventional, or maybe I'm not going to get maybe like 12 bananas. Maybe I'm going to get like 6, or, try to limit that kind of stuff. But today what I want to do is kind of go over these 3 pieces and also give you kind of a couple tips to be able to reduce the amount of expense that's incurred with these 3 items. So let's start out with a car. So when we think of a car, what people do is they typically go to a dealership. And when they go to the dealership, they're presented with options. They say, okay, I'm going to finance this car, I'm going to lease this car. And depending on what you want to do, a lot of people, they'll say, you know what, I'm going to lease it because I want to give it back to the dealership at the end of a certain amount of time. Or, you know what, I want to finance it because I want to own it for a longer amount of time and I don't want a car payment anymore. I don't care if I don't have a new car every couple of years. I just don't want the car payment. But no matter what you do, when you drive that car off the lot, it is instantly depreciating in value. And what happens is a lot of people, when they drive off the lot, they find that they are upside down or they're negative in equity in the car when they drive it off the lot. Because that car is no longer a new car, that car is a used car. So if you think about it, not only do you now have depreciation on the vehicle, but you end up spending interest. You have to pay interest to the lending institution every single month for owning this vehicle. And so it doesn't matter whether you lease or you finance, you're still paying interest on owning the vehicle or leasing the vehicle. But the thing is with a lease, when you lease a car, you're only paying for the amount that you use. They call it a residual. So you're only paying the monthly payment based on the residual value of the car, or how much the car is worth at the end of the 3 years. So it's how much you use. So normally in a lease, the payments might be a little bit less because you're paying for the residual only. However, if you finance a car, you might find that the payments are a little bit higher because you're not paying for just the amount that you use, you're paying for the entire cost of the vehicle. But again, somebody might be saying, well, I don't really want a car payment. I want to pay off the car. I want to keep it for 6 or 10 years, and that's that. And that's totally fine. For people that want a slightly lower car payment potentially because you're paying for just the residual and not the entire vehicle, and for somebody that wants to maybe trade in the car every couple of years, normally 24 to 36 months is the average lease, then a lease is for you because you get a new vehicle at the end of the term if you choose to get a new one, and you're paying a little bit less potentially in monthly payments because you're only paying for what you use, okay? So some of the ways that you can actually lower the payments that you're paying for the car or the truck or whatever vehicle you choose is to start a business. So when you start a business, you can potentially write off all of the expenses that are associated with that vehicle if you're using that vehicle for work purposes. Now, there are other kind of semantics that go into it, other calculations that go into it, but for the most part, you can deduct the expenses that occur on that vehicle. So if you have a lease, for example, you can deduct the lease payment and you can deduct the expenses like the mileage and the fuel and all that kind of stuff. Depending on what kind of business you have and what you do, you'd have to look at the specific tax code, but you'd be able to deduct some of those expenses on your taxes, which is in fact reducing your taxable income. So if I make $100,000 per year and I had $20,000 in vehicle expenses, I now only have to pay $80,000 of tax, or I only have to pay taxes based on $80,000 as opposed to based on $100,000. So that's really an incentive to start a business, is that you can start deducting those expenses. The second thing is a house. So that's another liability. A lot of people think it's an asset. I think it's a big lie. That's my opinion. I don't believe your house is an asset. I believe the true American dream is to have entrepreneurship and to have capitalism, right? To start a business, to start to make passive income, passive cash flow. And so for the house, I believe it's a liability if you own the house you live in, you love it, it's great. I'm gonna buy the house, I'm gonna live in it with my family, make payments on it. You might pay a little bit higher interest because you love the house, that's fine. But then there's also another way to do it where you're actually purchasing a rental property. So I suggest purchasing a rental property with no less than 2 units, because if one person leaves or if one unit leaves, you still have the other unit that's paying your rent. And the goal of a rental unit is you want to have cash flow from that rental unit. So what does that mean? That means that whatever you're getting paid from the people that are renting the house from you minus your expenses, that's your cash flow. And the goal is you want to have consistent cash flow every single month from the people that are renting from you. Now the cool thing is you can actually deduct the expenses from owning that home on your taxes because it is a rental property. The government gives a ton of tax breaks for people that own rental homes. So that's a huge way for you to deduct on your taxes. So say you make $100,000 per year. And let's just say you bought the home and you have $50,000 worth of expenses from the home. Well, now you're only paying taxes on $50,000 as opposed to $100,000. So that's a huge break. Now you can deduct mortgage interest if you own the home, if you live in it, you can deduct the mortgage interest from that. But you can't deduct things like, leaky toilets or new roofs or new chimneys or things like that. Paint to paint the house. That's all deductible on a rental property. So that's something else to keep in mind to consider. The last thing is food. So guys, this isn't the food that we go to the grocery store for and we come home, we feed our family for a week based on what we buy. This is when we go out to a restaurant, we spend a couple $100s with our family to go out to a really nice restaurant, and we have a really great time and we have really great food. And we did this because we're super tired and we don't have time to cook, and we came home late and our kids are acting crazy and they're misbehaving, and so we're just going to take everybody and we're going to go to the restaurant, or we're going to take everything and we're going to order pizza, whatever it is. And so this is the type of food that this is like the extra stuff. This is the stuff that costs a lot of money one time, because you're going to a restaurant, you're having it prepared for you, or you're ordering in, you're having it prepared for you, and it costs a lot more that way, especially if you have a larger family. And so this is something that people don't see because A, they don't budget for it, or they see it in their budget and they say they're going to make changes, but they don't make changes, and then the next month comes around and they still don't make changes, and before you know it, people are spending $1,000, $1,500, $2,000 every single month just on eating out. So the first step here is create a budget. Create a budget, be super honest with yourself. Like where do you currently stand? Where do I need to improve? Because you can't measure what you don't track. And so we want to create a budget, want to make sure we track it, want to make sure we put in habits to be able to stick to it, and then we start to track it down the road and see our progress on how much money we've actually saved. And that includes all this stuff. That includes expenses for the home, expenses for the cars, everything like that. We want to make sure we budget for all that stuff. And so guys, I hope this helps. I hope this gives you a little bit of idea of how you can kind of minimize the expenses that are a result of these liabilities, of course, excluding the food. But these are some of the things that we want to do to be able to minimize our expenses when it comes to these 3 items. So I hope you guys got value today. If you have any other questions, please reach out at info@5pillarfinancial.com. That's info@5pillarfinancial.com. The 5 is spelled out. Until then, guys, take care, and we'll see you in the next video.